Let's talk about Roth. Roth comes from Senator William Roth. I think it was 97 when they came up with the Roth IRA. In subsequent years, they came up with Roth Options in qualified retirement accounts. What is a Roth option? Well, it's basically when you put money into an account after it's been taxed. So then it grows in a tax-protected way, just like it would in a tax-deferred account. But when the money comes out, typically in retirement, after age 55 or 59 and a half, depending on the account, it doesn't get taxed at all. So it's tax-free forever. And if you leave it to your heirs, they don't pay taxes on it either. And so it's cool in that it's been taxed, it's not going to get taxed again. In fact, sometimes if you can get money in there without it being taxed in the first place, it never gets taxed. For example, if you have a business and it's not a corporation, but it's a business where the only owners are their parents, and you pay them, that money is typically not taxed. They typically don't earn enough to pay income taxes on it. You don't have to pay payroll taxes on it. And then if they use it to make Roth IRA contributions, it never gets taxed. So everybody's into tax-free. Tax-free is great. Tax drag is a major expense, perhaps the largest expense when it comes to investing, and eliminating that boosts your returns. You simply end up with more money. Your money grows faster by not paying taxes. And so there are Roth options in all kinds of accounts. If you want to contribute to a Roth IRA, however, your income has to be below a certain amount. I think if you're married filing separately, it's just over a couple $100,000. I think if you're single, I think it's around $135,000. These are modified adjusted gross incomes, and those go up each year with inflation. But you can still contribute to a Roth IRA. You just have to do it indirectly, aka via the backdoor Roth IRA process, which is basically a two-step plan. First, you contribute the money to a traditional IRA, and you probably don't get a tax deduction for that. So it's kind of non-deductible traditional IRA money. And then the next day, you convert it to a Roth IRA. Since you got no deduction, there's no tax cost on the conversion. And in the end, it's just like you had contributed it directly into a Roth IRA. Now, obviously, there's a few little things to pay attention to. Otherwise, you wouldn't see so many questions about the process. You got to be aware of the pro rata rule, which means you can't have money in other IRAs, SEP IRAs, or simple IRAs at the end of the year when you do a Roth conversion during that year, or that conversion gets prorated. You don't want that. And, that's the main thing to avoid. Of course, you got to make sure you report it right on IRS Form 8606 with your tax return. And IRAs are individual, so there's one of those for each spouse if you're filing a married filing jointly return. But other accounts can also have Roth options. You can have a Roth option in your 401k. You can have a Roth option in your 403b. You can have a Roth option in your 457b. All of those can have Roth options. The nice thing about that is you get the choice. And in fact, even if you don't like the choice you made, many plans will even allow you to do an in-service conversion, meaning you move money from the tax-deferred portion of the account into the Roth account, paying the taxes on that. And so look for those options in your plan. It's plan dependent. The IRS lets them do in-service conversions. It lets them do Roth contributions, but the plan may not have that option. So you got to get the details on that from your HR folks and figure out what your plan allows. The nice thing about making Roth contributions as opposed to tax-deferred contributions is the government lets you make a contribution of the exact same size. For example, the employee 401k, 403b contribution, which is precisely the same size as the 457b contribution, at least when you don't take catch-ups into consideration, is $20,500 this year for those under 50. And so you can put $20,500 into your Roth 401k, or you can put $20,500 into your tax-deferred 401k. But the truth is, if you're like me in a relatively high bracket, you're actually putting more money in on an after-tax basis if you're making the Roth contribution. So really what you should be comparing is putting $20,500 into a Roth account, or putting something like $13,000 into a tax-protected account and investing another $7,000 or so into a taxable account. So the idea is that you can actually put more money in when you're putting it into a Roth account. And so that's why if the tax rates are the same upon contribution as upon withdrawal, Roth actually comes out ahead. However, that's not actually the case for most docs in their peak earning years. Most docs in their peak earning years are in the 32%, 35%, 37% bracket. And when they take that money out during retirement years, they're going to be able to withdraw it, filling the brackets as they go. If they don't have any other taxable income, before they start getting Social Security, or there's no rental property income or some pension or something, you can basically take out, the standard deduction amount tax-free. So if you got a 37% deduction when the money went in and you pull it out at 0%, that's a huge arbitrage. And that's why tax-deferred accounts work really well during your peak earnings years. And then you can take out a certain amount more, 20,000 or so out at 10%, another 50,000 or so out at 12%, and another 75,000 out at 22%. And so the idea is you put money in there, saving 32, 35, 37%, whatever, when the money goes in, and then only have to pay 0, 10, 12, 22% when you take the money out. So that's a huge arbitrage. And that's the best argument against using a Roth contribution, is just because the tax savings, the additional tax savings, aside from having decades of tax protected growth, that you get from using a tax-deferred account. But if for whatever reason you're going to be filling those brackets with other income, a pension from the military, or a bunch of rental property income, or Social Security contribution or Social Security payments, et cetera, if you're going to be filling all those low brackets with other income, then Roth starts making a lot more sense. Also makes lots of sense if you're a super saver, right? If you're going to end up with $20 million in retirement, you're going to have some huge tax-deferred IRA eventually. Those sorts of reasons are reasons why you may want to do more Roth now. It also can help save you on estate taxes, because the stupid IRS, they look at $1 in a Roth account as exactly the same as $1 in the tax-deferred account. So if you're knocking on the door of the estate tax exemption, doing Roth conversions or preferentially making Roth contributions can help you avoid estate taxes as well. So lots of benefits there. So those are things to keep in mind when you're trying to decide whether to do Roth contributions or tax-deferred contributions. Honestly, these are two good things, right? You're choosing between two winning ideas here. It's not like one is dramatically better than the other, but in some situations, it's better to use one. In some situations, it's better to use the other. Keep in mind your employer match is always tax-deferred money, even if you make a Roth contribution.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.